Natural Selection, Irrationality, Behavioral Economics, and Neoclassical Economic Theory, Part 2, by Spencer Antonio Marlen-Starr, published originally on February 4th, 2024, on my Medium blog. This article is a follow-up to a prior article I published here on my data science and economics blog several months ago. Introduction. To restate my thesis here, the main premise undergirding the subfield of behavioral economics, formerly known as behavioral finance, which in my experience has been that the standard positive, now parenthetical note, when economists say positive, they mean real world, predictions of neoclassical economic theory are not valid because the rationality axioms for individual market participants are violated, and not just violated randomly, but in predictable ways, is mistaken and misguided. By the standard predictions, I mean most of the results in economic theory which follow from the neoclassical synthesis, that is, supply and demand analysis, first introduced by Alfred Marshall in his landmark treatise, Principles of Economics, originally published in 1890. I have come across this claim multiple times in different guises. I have come across it when listening to the audio versions of two books written by major figures in behavioral economics, and again when taking an upper division elective as an economics major at UC Irvine called Econ 109, Psychology and Behavioral Economics. The first of the two books alluded to above was Thinking Fast and Slow, which I've listened to 3 times, by the way, by Daniel Kahneman. It was a really good book. Kahneman was one of the 2 Israeli psychologists, the other one being Amos Tversky, who first began charting and documenting the common cognitive heuristics and biases which behavioral economists spend so much time writing about. Kahneman and Tversky also co-wrote the paper Prospect Theory, proposing something of an alternative to the utility function of a rational utility maximizer. It really is too bad that so many of the papers he cites were not able to be replicated. Furthermore, a meta-analysis meant to estimate the proportion of the papers cited which would likely replicate if it was attempted in Schmack 2020 indicates that a substantial proportion of them would not. I say it is too bad because the overall narrative he used to present them was compelling, easy to understand, and more importantly, easy to remember. I have also listened to Dan Ariely, who's another Israeli psychologist turned behavioral economist, although to be fair, he also has a second doctorate in business as well. I've also listened to his book, Predictably Irrational, which came out around the same time as Thinking Fast and Slow. It was not a good book. Speaking of Dan Ariely, I feel it would be irresponsible of me to bring him and his shitty book up without mentioning that Ariely has recently been accused of tampering with data sets used in several landmark papers of his to make them fit his hypotheses in a fraudulent manner. And that is not the half of it. He has even been credibly accused of making up an entire experiment as well. There are links to the YouTube videos that explain these accusations in the article itself, which I will link to in the description of this YouTube video, so that I don't have to go through all of these accusations line by line and make this piece too long. These arguments made by behavioral economists have been used as the justification for regulations and other restrictions on markets and individual freedoms in the United States and the United Kingdom. This is the real reason it bothers me enough to put in months of research into this project. Next section. Is the rationality of individual market participants a necessary condition for neoclassical supply and demand analysis? Historically speaking, no. It was not. As I mentioned in the previous article, that is part 1, when doing a Control-F search in Alfred Marshall's Principles of Economics, I was not able to find any relevant matches for the key terms rational, rationality, axiom, transitivity, completeness. There were 2 hits for completeness, but neither of them were used in the sense it is used as one of the 3 rational choice axioms, and reflexivity, the latter 3 being the complete set of axioms required for rationality in modern microeconomic theory. This means that all of the results found in Marshall's mammoth treatise are analytically derivable without recourse to any formal notion of rationality. And, to be sure, the majority of the important predictions made by modern microeconomic theory can be found in that treatise. Indeed, the formal definition of rationality found in contemporary intermediate microeconomics textbooks, involving the three aforementioned axioms of completeness, reflexivity, and transitivity, were not even introduced into economics until the middle of the 20th century by von Neumann and Morgenstern and de Broglie. Next section. Theoretically speaking, also no. The most fundamental shortcoming of the critiques of behavioral economists about economic theory is that they only criticize the descriptive or predictive validity of the assumptions which are sometimes said to justify standard neoclassical microeconomic analysis, also known as price theory, about the characteristics of the individual participants in market economies. But economic theory is not about explaining or predicting the behavior of every individual in an economy. Rather, it is about understanding and predicting the market level outcomes. They seem to have utterly failed to consider the possibility that free market economies may be much less irrational, that is, less inefficient, than the people who act, operate, and participate within them, in which case their findings about systematic tendencies for humans system 1 to be characterized by quick and dirty biases and heuristics is interesting for its own sake, but it has no implications for economic theory. Now, I am going to quote the first two paragraphs of the criticism section of the Wikipedia article on behavioral economics in their entirety, because I wrote both of these paragraphs 2.5 years ago and have edited and expanded upon them multiple times since then. Quote, taken together, two landmark papers in economic theory which were published before the field of behavioral economics emerged. The first is the paper Uncertainty, Evolution, and Economic Theory by Armin Alchian from 1950, and the second paper is Irrational Behavior in Economic Theory from 1962 by Gary Becker, both of which were published in the Journal of Political Economy, provide a justification for standard neoclassical economic analysis. Alchian's 1950 paper uses the logic of natural selection, the evolutionary landscape model, stochastic processes, probability theory, and several other lines of reasoning to justify many of the results derived from standard supply analysis using firms. Parenthetical note. Note to the layperson reader, economists refer to businesses of all kinds as firms, end of parenthetical, which maximizing their profits are certain about the future and have accurate foresight without having to assume any of those things. Becker's 1962 paper shows that downward sloping market demand curves, which are the most important implications of the law of demand and of basic price theory, is the most important and fundamental claim, do not actually require an assumption that the consumers in the market are rational, as is claimed by behavioral economists, and they also follow from a wide variety of irrational behavior as well. The lines of reasoning and argumentation used in these papers is re-expressed and expanded upon in at least one other professional economic publication for each of them. As for Alchian's evolutionary economics via natural selection by way of environmental adoption thesis, it is summarized, followed by an explicit exploration of its theoretical implications for behavioral economic theory, then illustrated via examples in several different industries including banking, hospitality, and transportation, in the 2014 paper Uncertainty, Evolution, and Behavioral Economic Theory by Mann and Zwicky. And the argument made in Becker's 1962 paper that the pure increase in the relative price or terms of trade of good X must reduce the amount of X demanded in the market for good X is explained in greater detail in chapters, or as he calls them, lectures, because his textbook is more or less a transcription of his lectures given in his price theory course taught to first-year PhD students several years later. Lecture 4, which he calls the opportunity set, and lecture 5, called substitution effects, of Gary Becker's graduate-level textbook Economic Theory, originally published in 1971. End of quote. Because I included all of Becker's 1962 paper, as well as explanations and expansions in some parts, in Part 1, I will not expand further on how it really invalidates the relevance of single period, that is, one-off psychology experiments to real-world markets where interactions iterate over multiple periods. In fact, they can do so continuously, and where budget sets and consumption opportunity sets are limited. Next subsection. As an aside, I first heard about Becker's 1962 paper in an episode of the popular podcast Econ Talk with Nassim Nicholas Taleb as the guest. He and the host, the economist Russ Roberts, whose doctoral dissertation advisor was Gary Becker, actually, briefly talked about this paper, specifically how Russ had alerted Taleb to it and just how helpful Taleb had found it. And apparently, I'm not the only one for whom this brief part of that particular Econ Talk episode stood out to and inspired a deep dive for. Because if you felt the need to double check that I'm not lying about what the beginning of the criticism section of the Wikipedia page for behavioral economics says, or to check if it has changed if you are reading this a few years after it is first published, you'll notice, unless it has been edited and you're reading this in the future, that the first paragraph below my contribution discusses this exact Econ Talk episode, but I did not write that paragraph. Their discussion of this paper and how its implications are directly relevant for behavioral economics really spurred my curiosity as a massive longtime fan of Taleb's extended essay on uncertainty and opacity, which he calls the incerto. And having listened to the audio versions of all 5 volumes of it at least 3 times each now, and the best volume, Anti-Fragile, 6 or 7 times by now, I really have to disagree with a good friend of mine who is also a student of the Incerto, who came away somewhat disappointed from the most recent volume, namely Skin in the Game, because there wasn't really much new in it that wasn't already in the others. My friend was right more or less. However, I noticed a massive change in Taleb's tone from the original volume of the Incerto, namely Fooled by Randomness, which was originally published in 2001, and Skin in the Game, published in 2016, with regards to behavioral economics. In Fooled by Randomness, Taleb had claimed something to the effect that Kahneman and Tversky's contributions to economics were worth more than almost all prior contributions by all economists, which is quite a bold claim if I do say so myself. However, while Taleb's tone on behavioral economists had begun to sour in Anti-Fragile, it was still a noticeably large shift in Skin in the Game when he makes the same argument that Becker made in his paper, that is, that the rationality and/or order of a system does not have to depend on the rationality of its participants. Tangent over, kind of, but I've added an appendix to this article right after the postscript section, which explores the roles of optionality, convexity, and antifragility in the type of evolution which occurs in market economies. Next section, important takeaways from Alchian's paper. By all accounts, Armin Alchian was one of the deepest thinking economists of the 20th century, and one of the most original as well. He was the leading figure in a distinct school of economic thought composed mostly of economists who were professors at UCLA for their entire careers, part of their careers, or earned their doctorate in economics there. Naturally, it became known as the UCLA School of Economics. Besides Alchian, the UCLA school has also included other great economists such as Harold Demsetz, George Hilton, Sam Peltzman, Thomas Sowell, Walter Williams, and several others. In his 1950 paper, Alchian explains that in a real-world economy, due to uncertainty and incomplete information due to opacity, assuming purposeful adaptation by firms to changes in markets in real time which are correct is just too much to ask for. This looks bad for the theory of the firm, and therefore for standard supply analysis as well. However, he points out that there is a possible theoretical explanation of a very different nature which would still justify both. Rather than conscious adaptation only, Alchian looks to environmental, with the environment here being an economy, adoption of the firms which are most fit for survival, where survival means avoidance of bankruptcy. In his own words, quote, among all competitors, those whose particular conditions happen to be the most appropriate of those offered to the economic system for testing and adoption will be selected as survivors. End of quote. Note the phrasing, they happen to be the most appropriate, clearly indicates that which firms are adopted in an economy that is selected, again, which means those which are still in business at any given time, can be due partly, mostly, or entirely to chance rather than skill or effort for any individual firm within the economy. But this has not yet been made clear fully. So below I quote Alchian's first longer explanation in the paper. Quote, consider first the simplest type of biological evolution. Plants grow to the sunny side of buildings not because they want to, in awareness of the fact that optimum or better conditions prevail there, but rather because the leaves that happen to be exposed to more sunlight grow faster and their feeding systems become stronger. Similarly, animals with configurations and habits more appropriate for survival under prevailing conditions have an enhanced viability and will with higher probability be typical survivors. Less appropriately acting organisms of the same general class having lower probabilities of survival will find survival difficult. More common types, the survivors, may appear to be those having adapted themselves to the environment, whereas the truth may well be that the environment has adopted them. There may have been no motivated individual adapting, but instead only environmental adopting. End of quote. The reason why natural selection applies in largely free market economies is because they are fundamentally profit and loss systems. And the losses are just as important as the profits are to ensure system-wide outcomes which are beneficial. A firm only continues to survive in the market in the long run so long as it is able to maintain a positive rate of profit, again, in the long run. In the same way, natural selection only works in nature because each individual animal, bug, tree, bird, etc. can and does die. The great thing about Alchian's alternative approach here is that it only alters how the economist who uses it, thinks about how and why markets tend to clear, but the important concrete predictions are no different. Or as Alchian himself puts it, quote, as a consequence, only the method of use rather than the usefulness of economic tools and concepts is affected by the approach suggested here. In fact, they are made more powerful if they are not pretentiously assumed to be necessarily associated with and dependent upon individual foresight and adjustment. They are tools for, at least, the diagnosis of the operation of an economic system, even if not also for the internal business behavior of each firm. End of quote. When Alchian says that only the manner in which the standard economist's price theory, that is microeconomic theory, toolkit, which has been mostly the same since Alfred Marshall, I'm referring to demand and supply curves, cost curves, various elasticities, monopoly and perfect competition, etc., is to be employed by an economist in terms of explanatory power is altered by his evolutionary approach, not the substantive predictions about market outcomes. An applied example of using Alchian's adoption model to improve your ability to evaluate the empirical evidence in minimum wage research papers. Starting in the 1990s, several labor economists began using a new methodological approach to estimate the effects of increasing minimum wage rates on employment rates. This approach was to survey the managers or owners of the types of businesses which are known to employ many minimum wage workers right before and several months after increases in a statewide minimum wage rate, which was above the federal minimum wage rate after the increase. Or it could be both before and after the increase as well. In the first such study, These surveys were done over the phone with a similar number of firms in the fast food industry, both in a state that was about to undergo a large minimum wage hike and in a state bordering it. Unfortunately, there is a major problem with this approach to testing the economic hypothesis that a minimum wage rate increase causes disemployment effects for unskilled workers. This problem is known as survivorship bias, which is a problem of only looking at the characteristics of the survivors of a process in which not all participants survive, and making inferences about all participants from the survivors. If one were to use the same approach to soldiers going off to war, they might conclude that nobody died. This approach fails to take account of the possibility that the types of business firms which can survive a given change in government policy, in this case a minimum wage hike, may have already been more well adapted to the way their environment or market conditions were going to look after that change. For example, being less labor intensive than the types of firms which went extinct or bankrupt afterwards. Thus, the researchers removing those fast food restaurants which they had surveyed before the minimum wage hike but couldn't get a hold of again afterwards from their sample is a big red flag, methodologically speaking. Even if one assumed that there were the same number of firms in a given industry, let's go with the fast food example, which employs a large number of low-wage workers a year after a minimum wage hike as there were a year before, due to the entry of new firms matching the exit of firms which went under. If the ones which went under tended to be more labor-intensive than the average rate in the industry, and the new entrants had the same average rate of labor intensiveness as the prior average, that alone would lead to a decrease in employment in that industry. And that's just saying if the new entrants had the same rate of average, or the same average rate of labor intensiveness. This would be even more acute if they had a lower average rate of labor intensiveness. Now that I have presented an example of how to use an Alchinian approach to a controversy among economists when analyzing the results of studies just using the survival via positive profits as the selection criteria, which is only part of Alchian's model, I'll present the rest of it. The following quote is the final sentence before the conclusions and summary section of his paper. Quote, "The economic counterparts of genetic heredity, mutations, and natural selection are imitation, innovation, and positive profits." End of quote. We have already gone over the third part extensively, so there's no need to do so again here. But by imitation and innovation, Alchian argues that what many businesses do consciously in deliberate attempts to adapt themselves to their markets find themselves on a quest to attain, then maintain positive profits is imitating the successful businesses in those markets. However, they can only faithfully imitate what they can understand, and some aspects of any business will be opaque to any observer, so they will have to guess to fill in some of the gaps that they cannot directly observe in terms of how the successful firms in the industry they are entering operate. Some of these educated guesses will no doubt turn out wrong, which will cause their attempts to imitate the way the successful business they are imitating works to be less than 100% successful. To whatever extent they fall short in their imitations, they are accidentally introducing potential innovations to the extent that their particular way of not faithfully imitating the successful firm is unique compared to all the other new entrants in that industry trying to imitate the successful firm. Here's how Alchian puts it, quote, "Even innovation is accounted for by imitation. While there certainly are those who consciously innovate, there are those who, in their imperfect attempts to imitate others, unconsciously innovate by unwittingly acquiring some unexpected or unsought unique attributes which under the prevailing circumstances prove partly responsible for the success." End of quote. The analogies between heredity and mutations versus imitation and innovation are much more literal than I first appreciated the first 3 or 4 times I read Alchian's paper, mostly because I haven't taken a biology class besides marine biology at community college since I was a freshman in high school, so I don't know anything about genetics. As a result, I was unaware of the fact that genetic mutations are caused by errors made in the process of copying DNA. This means that the analogy between accidental innovation via imperfect attempts at mimicry, that is, copying the actions of observed successful firms by other firms in the industry, and genetic mutations via non intentional errors in the process of copying DNA is almost a perfect one. Clarification: what Alchian is not saying. Alchian does not claim that his alternative approach to markets via natural selection always ensures equilibrium in real world markets or the maximization of profits by real world firms, quickly, slowly, or otherwise. In fact, in his legendary textbook, University Economics, the latest edition of it, published posthumously, is called Universal Economics. He doesn't even use the term equilibrium. He talks about markets clearing or failing to clear. In his own words, in the conclusions and summary section of his paper, Alchian makes this quite clear. Quote, "The economist may be pushing his luck too far in arguing that actions in response to changes in environment and changes in satisfaction with the existing state of affairs will converge as a result of adaptation or adoption toward the optimum action that should have been selected if foresight had been perfect." End of quote. The reason he may be pushing his luck is because this evolutionary analysis does not ensure the sorts of pure, ideal, Platonic form-like outcomes in markets that the standard analytical tools in the economist's toolkit do when interpreted in the standard way. This is a strength in my view, and importantly, if used more wisely, it could also reduce the prevalence of the nirvana fallacy among critics of free enterprise and open markets. He further clarifies that the degree of accuracy possible in predictions made using standard economic analysis with his explanatory model in mind to a change in circumstances, for example, a discrete change in government policy, depends on how close the circumstances in the market are right before the policy change takes effect to what Alchian would call market clearing rather than equilibrium. Here is how he puts it, quote, "If profit maximization, that is certainty, is not ascertainable, the confidence about the predicted effects of changes, for example, higher taxes or minimum wages, will be dependent upon how close the formerly existing arrangement was to the formerly optimal certainty situation. What really counts is the various actions actually tried, for it is from these that success is selected, not from some set of perfect actions." End of quote. Next section. An underappreciated aspect of Alchian's paper. If you have made it through my very long first article and up to this point here in the second article and have not yet actually read Uncertainty, Evolution, and Economic Theory all the way through yet, please do so now. Then skim it again a second time. I'm being serious. As yet another brief aside, astute readers who will actually take the time to read or skim it more than once might notice that Alchian alludes to the evolutionary landscape framing of the general theory of evolution in this paper, which is quite remarkable given that it was not formally introduced into the biological sciences until 1932 by Wright, and it was not until 1944 that Simpson introduced the first evolutionary landscape model where the landscape itself could vary through time. Here is the section of the paper where it occurs, quoted in full with the relevant bits emphasized. Quote, "The second type of conscious adaptive behavior, in addition to imitation, is trial and error. This has been used with profit maximization, wherein, by trial and ensuing success or failure, more appropriate actions are selected in a process presumed to converge to a limit of profit maximization equilibrium. Unfortunately, at least two conditions are necessary for a convergence via a trial and error process, even if one admits an equilibrium situation as an admissible limit. First, a trial must be classifiable as a success or failure. The position achieved must be comparable with results of other potential actions. In a static environment, if one improves his position relative to his former position, then the action taken is better than the former one, and presumably one could continue by small increments to advance to a local optimum. An analogy is pertinent. A nearsighted grasshopper on a mound of rocks can crawl to the top of a particular rock, but there is no assurance that he can also get to the top of the mound, for he might have to descend for a while or hop to new rocks. The second condition, then, for the convergence via trial and error is the continual rising towards some optimum optimorum without intervening descents. Whether decisions and actions in economic life satisfy these two conditions cannot be proved or disproved here, but the available evidence seems overwhelmingly unfavorable. The above convergence conditions do not apply to a changing environment, for there can be no observable comparison of the result of an action with any other. Comparability of resulting situations is destroyed by the changing environment. As a consequence, the measure of goodness of actions in anything except a tolerable, intolerable sense is lost, and the possibility of an individual's converging to the optimum activity via a trial and error process disappears. Trial and error becomes survival or death. It cannot serve as a basis of the individual's method of convergence to a maximum or optimum position. Success is discovered by the economic system through a blanketing shotgun process, not by the individual through a converging search. End of quote. The interesting question is whether or not Alchian was aware of the evolutionary landscape model at the time, or if he just ingeniously thought of it on his own. I cannot ascertain the answer to this, but I would presume he read about it rather than coming up with it independently. Uncertainty, evolution, and behavioral economic theory. I was delighted when I found out about this paper a little over 6 months ago, as of the time of publishing this article, because before that, I was under the impression that I was the only one who had noticed the implications of Alchian's paper on behavioral economic theory. Because I am not an academic, the prospect of having a unique contribution matters little to me. On the contrary, what matters to me are the implications on neoclassical and behavioral economics themselves. I cannot praise this paper enough, truly. It contains many clever arguments against using behavioral economics as a basis for changing governmental policies that I never considered and I suspect never would have on my own. Rational individuals or rational firms? Quote, "There are two elements to an evolutionary model, variation and selection. Alchian argued that even if variation is entirely random, if the selection process is sharp enough, then it will seem that the variation itself was purposeful, that is, intended to produce the results it seems to solve. In other words, somewhat non-intuitively, for Alchian, the process of selection mattered more than the process by which variation is produced." End of quote. The sentence right after the last one above really reminds me of the type of concepts pointed out in Nassim Taleb's classic book, Fooled by Randomness. Here it is. Quote, "In particular, many important variations in the economic market bear no relationship to the intent of those who produce them in any given case." End of quote. Mann and Zwicky then restate one of the main points in Alchian's paper as an implication of the above. but in a different and useful way. Parenthetical note. Speaking for myself, I usually find it very helpful to see differently framed or worded explanations of the same point, concept, or hypothesis in order to really get them in my head. End of parenthetical note. Quote, a key implication is that it is not necessary for those individuals who work within a given firm to be rational in order for the firm to act as if it is rational. A firm might simply stumble upon some innovation that provides it with a competitive advantage against its rivals. If so, then that firm will prosper while others decline, regardless of whether the firm understands the source of its competitive advantage. Although Alchian made it clear that firms that do understand their competitive advantages will gain still larger advantages against their rivals. End of quote. I have highlighted and bolded the above sentence because it is quite reminiscent of a point that Taleb made about optionality in the first paragraph in the subsection called How to Be Stupid in Chapter 12 of Anti-Fragile, which is included below. Quote, if you have optionality, you don't have much need for what is commonly called intelligence, knowledge, insight, skills, and these complicated things that take place in our brain cells. All you need is the wisdom to not do unintelligent things to hurt yourself, some acts of omission, and recognize favorable outcomes when they occur. End of quote. The most important part here is the recognizing favorable outcomes when they occur. That is heavily emphasized by both Alchian and Taleb. Back to the paper by Mann and Zwicky. They put forth an ingenious argument to the effect that the presence of biases among individual market participants implies that surviving firms over time will have dealt with these biases on a comparative basis. That is, compared to all of the firms which have gone bankrupt. In other words, did not survive. Not all of the individuals in the surviving firms, but taking firms as the unit of analysis. Here is how they put it. Quote, the presence of behavioral biases might explain certain anomalies observed in the marketplace, but rather than implying market failures in need of corrective intervention, these insights might actually explain the sometimes curious institutions that have grown up to ameliorate any inefficiencies that might arise as a result of behavioral biases. End of quote. What do they mean by explain here? We'll see below as we continue quoting them, for the sake of explanation, what they mean by explain is in bold font below. Quote, first, as it suggests that even if there is widespread irrational behavior in the world, this simply creates a profit opportunity for producers that are comparatively less irrational in their decision making. Thus, over time, less irrational firms should outcompete more irrational firms, suggesting that only the most relatively rational firms will persist over time. Thus, the overall impact on allocative efficiency of even widespread irrationality may be minor if the marginal surviving firms are the most relatively rational firms in the market. End of quote. Implications on the efficacy of government intervention to correct potential economic inefficiencies caused by cognitive biases. Continuing the quote. Second, Alchian's model suggests that even in a world of irrationality, the number of market failures that require government intervention may be smaller than expected. In other words, although it is theoretically possible that certain biases could lead to market failures requiring government correction, it may be more accurate to presume that those firms that survive are those that have done the comparatively best job of creating internal structures designed, or not, to mitigate the costs of those biases to the firm's operations. Thus, through the evolutionary process of competition, firms that survive can be presumed to be the ones that have best solved the possible problems arising from irrational biases among their employees. This implies that before governmental intervention is urged as a response to the purported behavioral bias, a regulator should first determine whether the effects of the bias have already been addressed through the structure of firms themselves before making a persuasive case for intervention. Moreover, it implies that corrective action directed toward existing successful firms will necessarily be directed against the very structures that have proved most successful in ameliorating the biases that government intervention might otherwise hope to address. This would turn the justification for government intervention on its head. End of quote. How would it turn the justification on the head, you might ask? Quote, finally, as a corollary to the second point, the intersection of behavioral economics and Alchian's model of evolution suggests that the possibility that certain practices of successful firms, which appear to be inefficient, may actually be efficient if assessed more holistically in terms of their ability to ameliorate the effects of behavioral biases and uncertainty. In other words, second explanation of the corollary to the second point. Viewed against a more realistic world rather than a fanciful ideal, apparent relative inefficiency or even apparently harmful conduct may actually be relative efficiency. More simply, third explanation of the corollary to the second point, compared to firms that failed because they made different decisions, a firm's very existence is some evidence of its relative efficiency and something of a prima facie reason to refrain from deterring its particular conduct or structure. For example, it may be that certain apparent redundancies in decision making within a firm appear to be inefficient and the organization is in need of streamlining. But that conclusion may be dependent on the fanciful assumption that those working within the firm are rational. If, on the other hand, they suffer from various biases, then it may be that the firm's operational redundancies are actually an adaptation designed or happened upon by accident to check the aggregate impact of those biases. End of quote. In other words, firms may have practices and protocols that appear to be non-rational to third parties. That is fine, because these practices and protocols are for their non-rational employees. Furthermore, the point of these practices and protocols is to aid the operational dependability, increase profitability, decrease concave exposures, or some other important benefit to the firm, not to look reasonable or rational to third-party observers with no skin in the game if it goes under. Example from the banking sector. Later on in the paper, they review a paper by Rasmussen in which he looks at some practices which are standard within the banking industry, which appear to be rather curious, redundant, or unnecessarily complicated. In each case, Rasmussen finds that these practices actually serve to counteract the potential negative effects on banks from common cognitive biases among their employees. It would not be worth it to go through each and every example of these curious practices and procedures among banks. For that, you'll have to read their paper, or Rasmussen's paper for that matter. Instead, I'll mention several of them. Rasmussen points out that a loan officer who meets with a potential borrower who seeks to take out a loan for whatever reason will usually have access to much more specific information about that person's financial history and status than is contained and summarized in a standard credit report. The problem is that the loan officer might become too attached to the vision, dream, or plan any particular would-be borrower lays out for them, or to the client themselves to remain objective, and that is where the use of minimum credit scores can come in to establish a floor below which the decision to approve the loan is no longer possible for the loan officer, no matter how much he or she would like to. That is one potential way in which credit score checks can be thought of as methods of counteracting the effects of the cognitive biases of some loan officers working for a bank. Behavioral economists often point to the over-optimism bias, which, if large and true for loan officers, could be disastrous to banks. However, Mann and Zwicky point out the obvious fact that assuming most humans do in fact suffer from an over-optimism bias in many different practical contexts, the degree to which each person does would be along a spectrum or a distribution. It certainly would not be to the same exact degree for everyone in every situation, and most likely would not even be the same for any given person across all domains of life. Therefore, successful banks over time will be those who have hired loan officers with low predispositions for over-optimism in granting questionable or borderline loans due to temperament alone. Another bias they could help to mitigate is the confirmation bias. They may succumb to some extent after a very positive first impression, which causes them to mentally categorize a given loan as a probable yes that would cause them to overweight confirmatory evidence about the would-be borrower or to discount disconfirmatory evidence. Here again, having automatic minimum credit score requirements helps to prevent the possibility of particularly egregious cases of this type of confirmation bias motivated unwise loan granting behavior. As an aside, I'll say this is slightly different than the previously mentioned one where they like the person or the person's vision. This one is that they originally rated the likelihood of success highly, and therefore, because they rated that, they seek to confirm it, not because they like the person. To quote Mann and Zwicky at some length once again, quote, "Thus, Rasmussen suggests the use of credit scores in the loan application process may not simply serve an information function about the borrower's creditworthiness. If there are various biases that might be triggered through the personalized process of a loan application, the credit score may provide a mechanism for tempering those biases. Collecting credit score information may seem redundant, wasteful, and even harmful. After all, the loan officer can collect more information from the borrower than a standard form credit score. Nevertheless, they might serve an additional function not observed at first glance." End of quote. Now, skipping straight to the implications Mann and Zwicky draw from Rasmussen's banking examples for government regulations and other interventions to correct things which appear to be irrational by third parties like bureaucrats and regulators. Quote, "While behavioral law and economics can be used to define a potentially serious problem, potentially suitable for regulation, an apparent bias toward over-optimism and excessive risk-taking in banks, it may not follow that regulation is required because there are strong competitive pressures for banks to solve those problems on their own. Thus, regulation may seem unnecessary or even counterproductive if regulators ignore the systems that successful banks have evolved to confront the problem. Moreover, the insight that successful banks have likely developed internal mechanisms for dealing with any behavioral biases as well as problems of imperfect information, agency costs, and other potential problems suggests a corollary proposition that we may be able to infer that other apparent anomalies within firms may actually exist in order to restrain the effect of these biases. Thus, institutions that appear to be inefficient or redundant could potentially serve some function within the successful firm of offsetting the influence of behavioral biases that might otherwise negatively impact the operation of the firm." End of quote. They then they restate the major theme of the paper again in yet another way. But this point is so important and so dang clever that I'm including it too. Quote, "As noted above, an important implication of Alchian's insight is that government interventions aimed at correcting inefficiencies in firm behavior will necessarily, if inadvertently, be systematically aimed at firms and specific conduct that have evolved whatever apparent inefficiencies remain to best address inefficiencies. Given also the informational and psychological constraints of regulators themselves, more on this below, as well as the problems of intervening well in a complex environment, Alchian's article provides a powerful caution against intervention." End of quote. Government regulators and behavioral economics. As I mentioned at the end of the introduction, many behavioral economics enthusiasts have attempted to use it as scientific evidence that sound arguments against naive government interventions made by economists for as long as anyone alive can remember are no longer sound because their key assumption that humans are rational is wrong. As I have shown, this is misguided because it misunderstands what economics is intended to explain, which is, believe it or not, economies. The real problem here is that all of the System 1 biases pointed out by behavioral economists apply to regulators and lawmakers as well. However, they don't get eliminated by evolutionary pressures over time when they make poor decisions. Regulators stand to make no profits if they implement regulations well and those regulations have positive results on society. That is, they are not residual claimants to any social gains resulting from their actions. This means they face neither the prospects of profit or loss. To quote Mann and Zwicky again, quote, "The consequence is that political actors do not face selection pressures likely to eliminate poor variations in the regulatory policy market." End of quote. If policymakers are not the residual claimants of the consequences of their actions, who is? The voters. But voters are only able to give their feedback on the performance once in a very long while. And beyond just the System 1 biases common to all people in all walks of life, voters are also subject to the phenomena of rational ignorance, rational irrationality, or both. This point deserves emphasis. Regulators and voters are also subject to predictable irrationality to the same degree that consumers and producers are. However, voters are also subject to further biases only as voters, which do not come up in other parts of their lives. Once viewed in this light, it seems to me the biases found by behavioral economists strengthen the case for leaving market forces to operate with minimal intervention. Going back to Mann and Zwicky again, quote, "There is little reason to expect government to evolve ways to constrain its biases as Alchian describes private firms doing in pursuit of positive profits. The inefficient decision-making we see in government is not likely masking a hidden, efficient organizational response to counteract costly biases. Thus, irrational regulators in this situation are unlikely to outperform the market to consistently identify truly inefficient behavior in an organization faced with and measured against the market's selection mechanism that presents them with apparent inefficiency that is really the market's own response to the irrationality of market actors." End of quote. The problem with governmental decision-making processes is methodological. They are often not subject to feedback when they do not turn out well, and they are implemented all at once across the entire domain under the jurisdiction of the governmental body in question. There is no tinkering, no trial and error, no experimentation. One major exception I know of is how the communist Chinese state allowed more market activity within its borders. They began just by allowing the farmers of several small villages nobody cared about to sell their surplus produce. Those villages became large cities relatively quickly, then they allowed more market activity. This will be explored further as the topic of a future article of mine, hopefully. Next section. Specific part of Mann and Zwicky's 2014 paper which could be improved by the incorporation of Becker's insights about opportunity sets. The part of the paper Uncertainty, Evolution, and Behavioral Economic Theory which most clearly would have benefited from the consumption opportunity sets logic of Becker's 1962 paper is on page 573 in the official version and page 20 in this version that I've linked to in the paper on my blog in the first paragraph of section B called Consumer Protection and Behavioral Economics. In order to avoid any possibility of missing vital context, I'll just quote the entire first paragraph below. Quote, "A similar caution applies in the context of consumer protection regulation and the inference of market failure where none is present. Consider, for example, the theory of fee shrouding which has been invoked to purportedly explain pricing and other business decisions in markets ranging from computers to hotels to airline ticketing policy to credit cards. Based on a theoretical paper by Gabe and Leibson, the theory argues that there can be hidden or shrouded fees in contracts that consumers do not fully incorporate into their decision making, focusing instead on only the upfront cost and ignoring subsequent add on fees. Such overcharges will not be competed away because, the argument goes, consumers do not make consumption choices based on these shrouded fees. From a policy perspective, then, the argument concludes that consumer protection enforcement is necessary to protect consumers from businesses that prey upon their biases. End of quote. If you've read all of part 1 and this article up to this point as well, do yourself a big favor and try to see if you can figure out how the logic of limited consumption opportunity sets presented in Becker's paper as a theoretical argument can have implications in the opposite direction as this theory of fee shrouding before you continue to hear my bits about how that applies here. Becker's paper demonstrates that whenever consumers have finite budgets for the consumption of goods and services which are fixed in the short run, a relative price increase for some good or service which they are consuming necessarily causes a shift somewhere else in their consumption and or saving behavior. This limits the magnitude of these shrouded fees that companies could get away with, because if they are large enough, consumers cannot afford them. To get a mental picture of how this might look in a single concrete case, an airline which attempted to impose exceptionally large shrouding fees onto their ticket prices may end up with less revenue per flight due to some percentage of the customers who tried to buy tickets having their credit or debit cards get declined due to insufficient funds. This demonstrates that the phenomenon of price elasticity of demand can still apply without individual consumers consciously lowering their quantity demanded of the products after increases in their relative prices. The end for now. This part 2 article is still a work in progress, though, because I always end up editing my longer articles after publishing them, and often add more to them as well. So please let me know if you see any typos, grammatical mistakes, awkward wording, run-on sentences, logical errors in terms of fallacies or deductive errors, weak rhetoric, or anything else you think would merit my attention. Bonus section, postscript, the law of no numbers. Statisticians talk a lot about the law of large numbers, and everyone who has taken even a high school level probability and statistics course has encountered it. It justifies the use of the Gaussian distribution, aka the bell curve, and its easy to use sample estimators, the sample mean, sample variance, and sample root mean squared error, also unfortunately called the standard deviation in studies with large samples, given that they are random. Unfortunately, it is just a fact that many social scientists in practice draw general inferences about societies, polities, economics, or economies, or human nature from studies with small samples. Kahneman and Tversky facetiously refer to this regrettable phenomenon as the law of small numbers. Unfortunately for them, the situation is far worse when it comes to some well-known concepts within the field of behavioral economics. These are typically hypotheses or even speculations, which were originally introduced by one of the founding figures in behavioral economics. For instance, Daniel Kahneman, Amos Tversky, or Richard Thaler. They're the main ones, basically. Then cited years later by second or third generation behavioral economics scholars as successfully tested hypotheses, then cited by other behavioral economics scholars even later as fully fledged theories, then these results are the basis of legislation or judicial activism to intervene in real world economies. A stunning example of this pipeline comes from the paper The Behavioral Economics of Behavioral Law and Economics, published in 2018 by Todd J. Zwicky, who was the same man who co-authored Uncertainty, Evolution, and Behavioral Economic Theory. In that paper, Zwicky traces back how behavioral law and economics scholars came to the conclusion that when companies place surcharges on credit cards, it induces customers to switch to a different payment method or device. According to Zwicky, quote, the argument fundamentally traced back to offhand musing by economist Richard Thaler in a journal article in 1980, end of quote. Zwicky then quotes Thaler's offhand musing in full, so I shall do the same below. Quote, other kinds of evidence in support of the endowment effect hypothesis are less direct, but perhaps more convincing. I refer to instances in which businesses have used the endowment effect to further their interests. Credit cards provide a particularly clear example. Until recently, credit card companies banned their affiliated stores from charging higher prices to credit card users. A bill to outlaw such agreements was presented to Congress. When it appeared likely that some kind of bill would pass, the credit card lobby turned its attention to form rather than substance. Specifically, it preferred that any difference between cash and credit card customers take the form of a cash discount rather than a credit card surcharge. This preference makes sense if consumers would view the cash discount as an opportunity cost of using the credit card, but the surcharge as an out-of-pocket cost. Richard Thaler, 1980, page 45. End of quote. Notice how the only evidence provided by Thaler for this claim is its plausibility to him. Again, taking Zwicky's word for it, every subsequent paper on the subject of surcharging by credit card companies written by behavioral law and economics scholars cites Thaler's paper, and most do so as if his paper had demonstrated rather than just conjectured differential responses from real-world consumers to surcharging versus discounting in the way he speculated they would. The reason I chose this example is because it includes three of the most important founders of behavioral economics. I've already mentioned Thaler, but Tversky and Kahneman also ended up citing it incorrectly in the way described above 6 years earlier. Quote, 6 years later, quote, Thaler, 1980, drew attention to the effect of labeling a difference between two prices as a surcharge or a discount. It is easier to forego a discount than to accept a surcharge because the same price difference is valued as a gain in the former case and a loss in the latter. Indeed, the credit card lobby is said to insist that any price difference between cash and card purchases should be labeled a cash discount rather than a credit surcharge. Tversky and Kahneman, 1986. End of quote. It just keeps getting better and better from here, because by 1991, Thaler's armchair conjecture had ascended to the status of an explanation. That year, writing in the most widely read scholarly journal in all of economics, the Journal of Economics Perspectives, Kahneman, Jack Netsch, and Thaler, without any additional evidence besides Thaler's own speculation from 11 years prior, simply posited that, quote, imposing a surcharge, which is likely to be judged a loss, is considered more unfair than eliminating a discount, which is viewed as a reduction of a gain. This distinction explains why firms that charge cash customers one price and credit card customers a higher price always refer to the cash price as a discount rather than to the credit card price as a surcharge. Thaler, 1980, end of quote. As you can see, at this point, the only citation was still Thaler's 1980 article. How did this happen? It, it happened in a way that the great economist Thomas Sowell often says many fashionable ideas get accepted by intellectuals by sheer repetition over the span of years, without a speck of empirical or new, that is more rigorous, theoretical evidence provided or even being asked for. The most ironic part about this, it is often behavioral economists and their fans among non-economists who so often claim that neoclassical economists don't provide evidence for their theories. From there, a 1999 article published in the Harvard Law Review making the same case cited only Tversky and Kahneman's 1986 paper, which, as we saw, only cited Thaler's 1980 paper. Worst of all, it has even been cited as a social scientific explanation in official Supreme Court briefs. Not quite as bad, but also quite serious was its inclusion in Kahneman's aforementioned Thinking Fast and Slow, which was a book intended for a popular audience, which was wildly successful and influential. What's the big deal, though, some of you may be asking yourselves, or me? Well, to quote Zwicky's takeaway from this exemplar, quote, the point is that Thaler's claim is simply made up. Just is simply a made up, just so story that has been treated by subsequent behavioral economics and behavioral law and economics scholars as if it had provided empirical verification of the theory. Until recently, it was the only basis for the claims, for example, in each of the Kahneman articles. No other support is cited other than Thaler's 1980 hand-waving speculation. End of quote. That is why I have decided to take a page out of Kahneman's book by referring to this tendency in the behavioral economics literature as the law of no numbers. There already is a name that someone else came up with for this phenomenon of concepts, models, or hypotheses gaining acceptance among scholars, intellectuals, pundits, and or the public due to sheer repetition, namely an availability cascade. According to the Wikipedia article on availability cascades, they are, quote, self-reinforcing cycles that explains the development of certain kinds of collective beliefs. They can occur when a novel idea or insight, usually one that seems to explain a complex process in a simple or straightforward manner, or a way that comports with a very popular socio-political narrative, gains rapid currency in the popular discourse by its very simplicity and its apparent insightfulness. End of quote. This is the end of the postscript section. Next section is the appendix. The role of optionality, convexity, and anti-fragility play in economic evolution. In the evolving landscape of economic theory, the concepts of optionality and anti-fragility, as introduced by Nassim Taleb, offer profound insights into the dynamics of economic evolution. These concepts, when applied to the economic domain, illuminate the inherent mechanisms that drive adaptation and growth within markets and industries. Optionality refers to the possession of choices or options without the obligation to commit to any one path. In the context of economic evolution, optionality represents the flexibility and adaptability of economic agents to respond to unforeseen changes or shocks. This flexibility is crucial for survival and growth in the unpredictable economic environment. It allows for experimentation and innovation, or tinkering, as Taleb likes to call it, leading to the possibility of discovering more efficient, effective, or resilient practices. Optionality is the ability of entrepreneurs, agents, researchers, and others to take advantage of the positive products of volatility in the economies as they continue to evolve over time, even including the possibility of benefiting greatly from complex exposures to black swan events. Compared to the rational economic agents of many microeconomic theory textbooks, the degree of rationality required for economic agents to exercise the natural options which they come across is minimal. All they require is the ability to know a real-world option they are in a position to exercise when they see one. They just got to know it when they see it, basically. The evolutionary economics model, as presented by Armin Alchian, emphasizes the role of variation and selection in the economic sphere. Optionality introduces a variety of choices into the system, fostering variation that is essential for the evolutionary process. Anti-fragility, a term coined by Taleb, goes beyond resilience or robustness. While a resilient system resists shocks and remains unchanged, an anti-fragile system benefits and grows from disorder and stressors. This concept is particularly relevant to understanding how economic systems evolve over time. Taleb's illustration of the restaurant industry serves as a poignant example. Individual restaurants are fragile. They face high failure rates due to competition, changing consumer preferences, and economic downturns. However, this fragility at the individual level contributes to the anti-fragility of the restaurant industry as a whole. The failure of individual establishments paves the way for new ones, often with innovative concepts or improved business models. This constant turnover injects vitality into the industry, making it adaptable and robust over time, or rather, anti-fragile over time. The industry evolves by benefiting from the trials and errors of individual entities, embodying the essence of anti-fragility. This perspective aligns with the evolutionary economics model by highlighting the importance of diversity, experimentation via trial and error, and selection in driving economic progress. Incorporating the principles of optionality, convexity, and anti-fragility into economic theory and practice offers a more nuanced understanding of how economies develop and thrive, thus challenging traditional models that overlook the dynamic and adaptive nature of economic systems. The end.